Welcome to the Daily Update Podcast, where I'll go over the action in the market for Thursday, July 24th, and we'll see how things look for Friday, July 25th. Going over what happened on Thursday, the equity markets started strong, with the futures pointing to a higher open. The S&P 500 and NASDAQ both notched new all-time highs, but late-day selling erased most of the intraday gains, leaving the market virtually unchanged, up just 0.07% on above-average volume. This lack of conviction raises concerns about the market's staying power, especially as we move deeper into the summer. Despite significant news on the AI front, with President Trump signing executive orders to bolster American AI technology exports and data center infrastructure, tech and megacap stocks didn't see the robust gains one might expect. Semiconductors, a critical growth sector, underperformed relative to broader technology, signaling a potential shift in market dynamics that we've been watching. Meanwhile, small and mid-cap stocks lagged, while megacaps held up relatively well. The S&P remains positive across all time frames, but cracks are appearing beneath the surface. Sentiment is stretched, and several indicators suggest the market is overextended and potentially vulnerable to a pullback. Looking at the technicals, the S&P 500 briefly surpassed the R1 pivot point at 6374, but struggled to hold above it, chopping around before late-day selling took hold. The NASDAQ 100, meanwhile, faces overhead resistance at its R1 pivot point, a level to watch closely in the coming sessions. Short-term momentum indicators, including the Stochx RSI, Williams Percent R, CCI 14, and 20, remain positive, but are showing signs of overextension. The short-term RSI based on 9 periods and the slope oscillator are flashing extreme readings, suggesting caution. In the intermediate term, the CMB composite and standard deviations chart are also at elevated levels, with mixed signals from the momentum oscillators that we follow. Long-term trends do remain bullish, but the market is significantly distanced away from key moving averages, including the 20, 50, and 150 period moving average, indicating potential overbought conditions. We're also seeing negative divergences in indicators including the balance of power and TTM squeeze, alongside a mixed picture from the smart money indicators. The Chaikin oscillator has turned negative, and the NYSE McClellan oscillator is back in negative territory, though the S&P 500 McClellan oscillator remains above zero, supporting the bullish trend for now. Looking at economic and market context, on the economic front, new home sales for June came in at an annualized rate of 727,000, up 0.6% on a month-over-month basis, but below the 750,000 expected. Year-over-year, sales are down 6.6%, with rising home prices and a 10-year Treasury yield at 4.41%, which continues to pressure affordability. Initial jobless claims dropped to 217,000, better than the anticipated 225,000, signaling resilience in the labor market, though continuing claims remain elevated, but are still below the 2 million mark. The S&P Global U.S. Manufacturing PMI slipped below 50 to 49.5, indicating slight contraction, while the Services PMI rose to a robust 55.2, highlighting strength in the services sector. The dollar continues its decline, and reduced domestic oil production is keeping oil prices elevated despite recent announcements from OPEC Plus on their plans to increase output. Earnings season remains a tailwind, with most companies beating expectations, supporting current market valuations. However, forward PE ratios continue to be quite high, suggesting large cap and mega cap stocks are overvalued relative to historical norms. Looking at sector and stock highlights, in sector performance, tech and communication led the way, buoyed by the broader indices. However, Tesla took a hit, dropping over 8% after a poorly received earnings report. Semiconductors, while up on the day, underperformed the broader tech sector, a potential warning sign that we've been watching for growth-oriented investing. The financial sector also lagged the S&P 500 and continues to do so, and consumer discretionary stocks faced pressure. Small and mid-cap stocks continue to trail the large caps, with growth slightly outperforming value across market segments. Looking ahead to Friday, July 25th, the S&P 500 remains in a bullish trend across all time frames, but signs of fatigue continue to be evident. Seasonality data suggests a positive bias for the Dow and S&P for July 25th, though the Nasdaq may underperform. This will also finish out the week after options expiration, which historically leans weaker, although we are still up on the week so far. Key data to watch includes durable goods orders. The Nasdaq 100's R1 pivot point will be critical to watch. Breaking above could signal further upside, while a failure to do so may reinforce resistance. Geopolitical developments, alongside domestic policy noise, could add volatility. Investors should also keep an eye on the VIX, which remains below 20 but is approaching a seasonal period where spikes are common. That tends to be negative for the market. The SKU index remains elevated, and call buying suggests the market anticipates an upward move, which is often incorrect. But volatility risk premium is going up and causing a concern. In summary, the market's resilience is notable, with new all-time highs and positive trends across all time frames. However, overextended indicators, underperformance in semiconductors and small and mid caps, and mixed signals from the smart money indicators suggest caution. As we head into Friday, stay vigilant for economic data, pivot point breaks, and potential geopolitical catalysts that could sway sentiment. I hope you found this podcast helpful. For more in-depth analysis and commentary, the full-length daily video update is available on YouTube and Rumble right when the market closes each day. To access the videos immediately after they are available, or to access the daily newsletter, please click on the links below.